Good afternoon. This is Tom Alexander. It is Sunday, August 20th. It is 3:40 p.m. Eastern Time in beautiful Charleston, South Carolina. This is the weekly addendum to the written report that I send every week. I have a mailing list that will notify you of that report. And if you're not on the list, you want to be on the list, you'll get free stuff. I don't sell lists, so I'm not selling your name. But if you want to receive that or other free information, shoot me an email to tom@alexandertrading.com. You can also go to my website and just look under weekly update, and you will see the written version of this on the website under weekend update. And you will be able to go back if you choose and look at previous updates, and you can follow the progression of the development of the analysis, which is basically a lesson in auction market development. Everything I do is through the lens of auction market principles, how markets and all the markets that we trade are auction markets. They behave a certain way. They have to behave a certain way. And that is what I analyze, trade, and teach. So you can see the progression of that on the website, including starting with this weekend's report. So the markets have been, the indices in particular, actually all the markets, the gold, interest rate markets, all the markets have been incredibly narrative driven since the October lows. And that is going to continue to be the case for a while. Now, we have been due for some sort of retracement, and we're having it. Is this the end of it? Is this an important low? I don't really think so. If it is, well, we'll see. But I don't think it is. I do think that we're close to at least a short-term bottom that retraces something up into this range back towards the all-time highs. I don't think we're going to see a ramp directly to new rally highs from here. I think what is overdue is some sort of development. I think the market last week may have put in the low of an extreme of a range, and then the upper extreme is yet to be determined. There are levels in the report. We'll go through some levels in just a minute. But a couple of things about trading in general. Now, everybody, all traders, self-included, we tend to be a high anxiety bunch. We are nervous if we're in the market. We're nervous if we're out of the market. And it is that latter thing that I think that the more experienced you become as a trader, the more comfortable you get. I'm not completely 100% comfortable being out of the market now, and I'll probably never get there because, like you, I'm a trader. But I'm pretty comfortable. I'm pretty comfortable being out of the market, and I have learned the hard way over and over not to force things. And what I'm looking for are extremes. I'm trading market development, and I am about as lightly positioned right now in my accounts across all time frames. And I trade, day trade, intermediate term trade, et cetera. Many different instruments, options, futures, commodities, et cetera. And I am about as lightly positioned now as far as the indices are concerned as I have been all year. And I'm lightly long. I covered shorts. I was short early. I was very happy to see that decline. I certainly didn't make much money because I got short early and traded around it. But now I'm not sure what's happening from a trader's perspective. I don't see a super compelling reward to risk that would have me use my typical minimum allocation. I'm below my minimum allocation. Again, I'm net long. I'm looking for a bounce. I think last week could have been a low, short-term low. Maybe that lasts 3, 4, 5 days. Who knows? I don't know. But anyway, my point is that traders don't want to be patient, and that attitude is encouraged by the Twitter crowd that seems to know exactly what's going to happen every minute of every trading day and why it happened. I've only been trading 38 years. Maybe these people have a lot more experience, and maybe at some point in my career after I've been trading 60 or 70 years, I'll know exactly what's going to happen in all time frames every minute of the day, but I'm not quite there yet. So I'm going to exercise some patience. I do think that we're going to have incredible opportunities between now and the end of the year. Volatility seems to be picking up, and that's always friendly to traders, especially those of us that trade options. We like to see the high volatility because it opens up more strategic plays. Okay, let's take a look at some charts here. Okay, I landed on the S&P, so we'll just go through these very quickly. We sort of made it inverted V top. Now, this was tricky in here. It was extraordinarily two-sided with big battle. Last week was sort of a directional decline to the downside. Now, unless we're going to have some sort of waterfall decline, I think we're near a short-term low. And what we may get is some sort of development in a range, maybe like this. Okay, that's possible. We could even take out Friday's low marginally and then make a range. But I don't think we're going to see the same rate of change to the downside that we saw beginning last Monday, beginning on the 15th last week, straight down into Friday's low that occurred near the opening. The markets, the indices were so vertical on the way up. There's not really good from an auction market perspective. There are not really great levels to be potential quote unquote support. 43.27 is a stab. Below there's a volume node down here at 42.57, 42.78. Let's look at the Russell. Now let's look at the Russell last, because I think it's the most important. Now the NDX is truly in the middle of nowhere. There's nothing between Friday's low and this level from an auction market perspective. We looked at the SPX. Let's look at the Dow. Now I mentioned last week, and I encourage you to go back and look at the weekend report from last weekend, because I sort of featured the Dow in that, because we had this extremely Gaussian looking, very mature balance area, quote unquote, market profile structure that pointed to the inevitability of a sharp move. And that is exactly what occurred. Now the Dow is in the middle of nowhere. The next level is down here, 33,900, 33,621. One thing I'll point out here, I have this 3,500 level as marking an upside to keep an eye on. It probably would be resistance if we traded back up there. But that also, the level, we broke above this area here that was formed. The spike high was on the 13th, but that was sort of a top also formed on the 1st of December, not too far from the high back in last August, a year ago. So this general area took a lot of power to get through here, a lot of energy, market energy to get through here. Well, we're revisiting that area. So it's going to be interesting to see if indeed we hold in here. Now, finally, I want to discuss the Russell, because I think the Russell is the most important at the moment of the 4 primary U.S. trading indices. And those of you that have been listening to me and following my weekend updates over the past year or so know that I have been fixated on the Russell. The reason I've been fixated on the Russell is because it is the broadest U.S. index. It is considered to be the best barometer of overall health of the U.S. economy, et cetera. It has a lot of banks in it, et cetera. And, the hook that kept me from being more aggressively bullish and really I was reluctantly bullish on the huge ramp in the NDX and the SPX and the Dow, for that matter, was because the Russell was not participating. And then all of a sudden, the Russell did catch fire in early July, but it stopped right here at this level. And this is a level I've had highlighted for many months. And again, you can go back and you can look on previous weekend updates, and you can see that this level is not new. Well, we inverted V-topped and we've traded straight down. Now the Russell is testing a super critical level. I was fixated on this level for months and the inability of the Russell to break through it. It finally broke through it, came back down, tested it, played games, and then ripped above it. Well, now we have traded back down into this level. I think this is an absolutely critical level, intermediate to long term, regarding the direction of the U.S. indices. Now, I still think, regardless of whether or not this level breaks, I'd be a little bit surprised if they just tear through this level now and we go ripping lower. I would be sort of expecting a more balanced area, more consolidation. This is just too vertical off of this top. This is not typical auction market structure. The structure would suggest more of a pause, more of a balance in here, and it remains to be seen how much balance we get. Now, the current narrative is going to be the Jackson Hole Fed meeting that starts next Thursday. It starts the 24th and it runs through Saturday. So you're going to have all this noise, all this chatter through next weekend and into early week after next. So just be prepared for that. Be prepared for choppy air pocket trading, up and down, all over the place. We might have 1 or 2% moves, and then the next day it reverses by the same amount. So just be prepared for that. But from a structural perspective, I think we're near, as we head into the early part of the week, near a short-term low. And, maybe we formed a short-term low and they're going to ramp it higher into Wednesday or Thursday, and then they'll start talking and the market will revisit and et cetera. But again, I'm quite comfortable here being lightly positioned. There's going to be enormous opportunities from now into the fall. This is typically when volatility picks up between now and the end of the year. There is no point in flipping a coin and going all in, long or short in here. This is pointless. So don't do that. Okay, let's look at the internals, which I think are particularly interesting at this point in time. Now, sometimes they're not helpful. And what I use very simple stuff. I use NYSE data, specifically advancing and declining issues, and then the net of that, which of course is breadth. The 10-day moving average of NYSE advancing issues is at a level from where you very often get at least short-term rallies. Now, I've said this many times about breadth. Breadth is sort of a blunt instrument. It cannot be rote traded. It has to be put in the context of other stuff. But breadth is also much more effective in identifying lows than it is highs. Is this a low? I'm alert to the idea that we're close to a low. Now, if we were to have some sort of surprise waterfall decline early next week, I would probably get aggressive buying this because it would throw all of this into red light extremes from where your reward to risk would be incredible. But what I think is going to happen here is that we're close to a low. We're going to have some sort of balance, and we'll see from there what the structure looks like. Now, speaking of structure, let's just take a look. Market profile. Okay, this is the SPX, and I have been putting a progression and a potential path in the report for months or weeks. And what you see on my screen here, these are, each profile unit is 1 month. Now you have to be careful when you are chronologically constraining the auction, because the market is an ongoing auction flow. You have to be really careful about pigeonholing a market that is dynamic and constantly moving from one phase of development to another, one auction market phase of development to another, in all time frames all the time. Now, with that qualifier, if you look at last weekend's report, I had this level identified as one of the potential paths in the market bottoming in here. Well, we overshot a little bit. Now, what I think If I am right, we're probably going to go up and at least test this area. If I'm wrong and we get a washout, you're going to have a very vertical structure here. And then maybe we're forming what the market profile people will tell you is a double distribution, which is basically another auction range on top of the auction range within the chronologically defined period that you're analyzing, if you follow all that. So it's getting more and more interesting from several perspectives: a structural perspective, a technical perspective. The fall and into the beginning of the year should be really fun. It's been a difficult year to this point. Speaking personally, maybe you've knocked it out of the park. I have not, but I have high hopes for the second half of the year. I hope you've enjoyed this. If you found value, please like, please subscribe. I will see you guys soon.